Shearman & Sterling is a full-service global law firm. Shearman has 24 offices and over 850 lawyers around the world, practicing in more than 20 different practice areas. Shearman's real estate group is involved in all the traditional categories of real estate practice, including acquisitions and dispositions, joint ventures, finance, and leasing, covering real estate of every asset class and type, and handling not only single asset transactions, but also portfolio transactions that span, in each case, all areas of the U.S. and internationally. We are pleased to offer this webinar to our clients and friends. Although we address a variety of different subjects, this webinar is not meant to be an exhaustive presentation on the topic. If you have any questions or would like to discuss any aspect of the presentation, please do not hesitate to reach out to me or any of the presenters. We look forward to hearing from you. As the U.S. enters an economic downturn, a topic that is top of mind for every real estate investor is distressed assets. It's no secret that many of the real estate investments made during the last downturn were among the most profitable. If you look at the period from August 2008 to June 2010, U.S. commercial property prices fell by about 35%, and prices over the last decade or so have more than doubled. This time around, private capital investors as a whole have more capital at their disposal. They also have expanded operating capabilities and real estate expertise. So by and large, investors are in a better position to invest today than they were in 2008. Although real estate investors are eager to find opportunities, many remain in a holding pattern. Some are still in defense mode, taking necessary action to support their existing portfolios. Some are waiting for a level of stabilization and for credit markets to normalize. Some investors are just generally apprehensive, since the origins of this crisis, a public health issue, are very different from the last. No one's able to predict how COVID and COVID-related government orders and mandates will continue to affect the economy. It also remains unclear how the pandemic may change the real estate market and demand going forward. The effects on real estate will vary by sector and market, but it's hard to deny that change is coming. And as values steeply decline, many owners are trying to avoid fire sales in the hopes of a strong economic recovery. Many of them are biding time through forbearance agreements with lenders, government assistance, and other temporary measures. But it's only a matter of time before things do stabilize and those temporary measures run their course. Although it is still early stages for investing in distressed assets in the current downturn, industry players are sizing up and discussing opportunities. And we are now beginning to see actionable opportunities emerge. Distressed assets often come with a number of legal issues and considerations, and distressed transactions generally close on a very compressed time frame. With that in mind, to help our clients and friends navigate some of these legal issues and considerations, I conducted 7 separate interviews virtually with a total of 14 of my colleagues from Shearman's real estate, tax, bankruptcy, and environmental practices. We cover purchase and sale agreements, joint venture documents, financing, due diligence, and tax, bankruptcy, and environmental aspects. In this market and during these unprecedented and unpredictable times, it's critical to approach the negotiation of the purchase and sale agreement in a measured and commercial way. It will be important to pick the right battles to provide the proper level of protection from a legal perspective, but doing so in a way that does not cloud or ultimately defeat the strategic business goal of acquiring the asset in a short time frame. Real estate partner John Opar and real estate associate Jonathan Newman join me next to provide some tips when negotiating the purchase and sale agreement in this market.
The COVID-19 pandemic has obviously had a tremendous impact on our society generally and on the way in which we do business. What is the likely impact of the pandemic going forward on contracts to acquire real estate?
Sure. Thanks, Kris, for having this. One thing we've seen already is we've seen sellers asking for the ability to delay the closing date in the event of COVID-related delays. So as we know, the typical purchase and sale agreement will have a time of the essence requirement, particularly on the seller's obligation to close on the closing date. And one way the sellers have addressed this pandemic is by adding provisions which would enable them to delay the closing date in the event of specifically COVID-related delays. So, for example, if the recording office or the title company office, the escrow agent's office is closed due to a state-mandated shutdown, that would be a reason or an excuse, if you will, for the seller to delay the closing date until such time as that issue is remedied. One way we've seen buyers respond to that sort of request by the seller is first by making it mutual, so the buyer itself has the same rights to delay the closing date in the event of a COVID-related delay. But another way a buyer can respond or has responded is by requesting extensions to its due diligence period. So as we know, many contracts will have a diligence period under which the buyer can conduct its diligence on the asset before it decides to proceed. And we've seen buyers negotiate extensions to these diligence periods to account for certain COVID-related delays. So for example, if the surveyor can't get on the property due to some state-mandated regulation, or if some other third party can't complete their report, again, due to COVID in particular, that would be an excuse or a reason that the buyer can point to try to extend their diligence period until such time as that issue no longer exists. Obviously, it's very easy to see how these sort of extension rights can be misused or abused, and so anybody negotiating a PSA in this environment, it will be critical for them to be sure that those rights are narrowly tailored and are specific to exactly what sort of issues and problems would give rise to the right to extend the closing date or the diligence period. One nice thing about a PSA is that it's typically a short-term contract, and so one can be quite specific in addressing the nature of the underlying pandemic or issue, and address it quite specifically. So again, in this COVID context, the situation can be addressed quite specifically with reference to COVID-19 in particular, and also particular state orders, regulations, rules, and that will help keep the rights narrowly tailored. Not compare, for example, this ability versus in the leasing context or in other longer term contracts where it isn't quite as easy to narrowly tailor the force majeure provision, for example, because in a lease where you have such a long-term period, the references to the present situation won't necessarily provide sufficient coverage for what the parties are trying to address. So that's just, Kris, that's just one example of something we've seen already addressed in PSAs as a result of the current environment. Certainly there's many other collateral impacts that we're still sort of seeing play out and emerge as a result of this current crisis.
The distress in the commercial real estate market is expected to attract many opportunistic buyers. For those who may be venturing into real estate acquisitions for the first time, what do you see as the key points of differentiation between real estate purchase and sale agreements and those used to acquire other assets, let's say typical M&A purchase agreement?
Thanks, Kris. Yes, there are significant differences. I think the differences include the approach to closing date, the extent of representations and warranties on the part of the parties, and the remedies available to the parties for breach of representation and warranty, and the overall approach to remedies for non-performance by one of the parties to the contract. The contract, a typical real estate contract, is likely to specify a calendar date for closing. That date may be characterized as time of the essence. Time of the essence is a term of art and understood by real estate practitioners as having particular significance. If the purchaser fails to close on the specified time of the essence date, and obviously I'm assuming here that the conditions to closing have been satisfied, the seller would have the right to terminate the contract for failure of the purchaser to close and to retain the deposit as liquidated damages. The deposit, the earnest money that is put up by the purchaser at contract signing, could be as high as 10% of the purchase price, but it will likely decline as a percentage of purchase price as the size of the commercial transaction increases. For a large commercial transaction, one might expect a contract deposit in the amount of perhaps a few percent of the purchase price. Essentially, the test would be simply, is the amount large enough that the purchaser would think twice before walking away from the contract and forfeiting the deposit? The approach here would contrast, I think, significantly with that in a purchase agreement for an asset, let's say, prepared in the context of a M&A transaction. There, you might see simply that the closing date will be a number of days after closing conditions have been satisfied, with the right on the part of the parties to terminate the contract if the contract has not been performed other than because of a party default by a specified date. There could be a deposit amount posted by the purchaser at closing, and at contract signing, but it's not necessarily customary. Another difference in approach would relate to representations and warranties, and Jonathan will address that more fully. I would only point out here that the extent of the reps and warranties given by the seller will likely be less extensive than one might expect in a corporate context, with a much greater reliance on the part of the purchaser for its own diligence. The remedies available to the purchaser for a breach of representation discovered after closing will likely also be more limited than they would be in a corporate context. A cap on the damage claim that the purchaser would retain against the seller would likely be a small percentage of the purchase price, often an amount roughly equivalent to the amount of the deposit. The timeframes for the purchaser to make a claim would also be significantly limited, with perhaps a year being at the very long end of the spectrum, and often a survival period for breaches of reps and warranties that would be significantly shorter, maybe in the range of 90 to 120 days. The purchaser would retain a limited claim against the seller for breach, but it is, again, contrasting with that in a corporate context, much more limited. In a corporate transaction, one would rarely see damage claims or caps on damages that would be less than, let's say, 10% of the purchase price. And in fact, in certain circumstances, they could be without limit. In the case, let's say, of fundamental representations. One key reason for the difference in approach is title insurance. That will be discussed separately, but the availability to the purchaser of title insurance coverage, in the view of many in the market, would obviate the need for the additional purchaser protections that it might otherwise seek. The third difference in approach, I think, relates to the overall remedies available to the parties for non-performance. Real estate is considered at law to be a unique asset, meaning that the purchaser is entitled to enforce the contract to seek what's called specific performance if the seller breaches its obligation to convey the property. If this remedy is available to the purchaser, and it would typically be available unless, let's say, the seller had otherwise contracted to sell the property to someone else, the purchaser is obligated, or is essentially given the opportunity only to seek specific performance of the contract, and other remedies that might be available, for instance, damage claims, would be either non-existent or significantly limited, let's say in the case of a willful breach by the seller, to recovery of some portion of the actual costs incurred by the purchaser in undertaking the transaction. Again, contrast that with a contract prepared in the mergers and acquisition context, where the reliance on damage claims and indemnification would be much more significant than in the real estate context. Thanks.
Thanks, John. So if we could drill down a bit on some of those key elements of real estate purchase and sale agreements, how, for instance, do the parties approach the seller representations and warranties?
Sure. This is, representations and warranties in a purchase and sale agreement is one of the key points of tension between a seller and a purchaser. The general approach in the U.S. real estate market is based on caveat emptor. So a seller's preference, obviously, is to sell its asset, its property as is, whereas, and the ability to negotiate representations and warranties is typically very highly market driven. So this is one of the key elements of negotiation between the buyer and the seller. One of the things that sellers obviously will try to do with respect to the reps that they do give is qualify those reps by knowledge, and the knowledge specifically of certain individuals, or they'll tie it to some other objective marker like the receipt of written notice or some combination thereof. The rule of thumb, generally speaking, in real estate contracts is that the willingness of the seller to make a rep is tied to the ability of the purchaser to whether or not the purchaser can independently verify and do its own diligence on that item. So, said another way, to the extent the buyer can figure out a particular item or point of diligence on its own through its own independent verification, the seller will be unwilling to make a rep with respect to that fact. So, for example, on environmental issues, a seller will typically be very, very hesitant to make any environmental representations. And their response to the buyer will be, listen, if you want to do your environmental diligence and go out and get a phase 1 report on the property, you are welcome to do that. But I am not going to make a representation on that topic. The same goes for items in leases at the property. The seller will say, listen, I will provide you the leases. You can look at them and figure out what's in them and whether you are comfortable with what's in them. I'm not going to make a rep as to the content of those leases. This ties, of course, to title insurance. One thing that's quite common in the M&A context, in M&A purchase and sale agreements, is the seller almost always provides a rep that it has good and marketable title to its asset. That rep is not customary at all in the real estate context, and that's because of title insurance. The seller will say to the buyer, I will not be making a rep as to the title, my title to the asset. You can go out and purchase title insurance to provide yourself with comfort on that topic. And of course, title insurance in the real estate context is incredibly common, and that is how buyers typically get comfortable that the seller has title to the asset. Other points on representations and warranties. One other thing that will be important for the buyer is to make sure that it's a condition precedent in the contract that the representations and warranties that the seller has made are true and correct as of the closing date. That's how the buyer is able to get protection for the interim period between the signing of the contract and the closing date. And another way you could do this, which is quite typical, is to require that the seller provide a bring down certificate of its reps as of the closing date and make that certificate a closing a deliverable. That's the mechanism to provide the buyer with a modicum of comfort that the representations it did negotiate and get from the seller will be carried through the closing date. I know John will address more fully what happens if the buyer acquires the property and then realizes that one of the representations or warranties are untrue after the closing date.
You mentioned title insurance. Should the purchaser consider acquiring representations and warranties insurance policy?
Yeah, that's a great question. And we have certainly seen an uptick in the use of representation and warranty insurance in the United States and in US deals, but it is still not nearly as extensive as it is in Europe. We most commonly have seen it in the M&A context, and particularly in REIT-driven stock acquisitions. It is far less common in asset-level commercial real estate transactions. The reason for that, Kris, is there's a couple of reasons, but the two main gating reasons why representation and warranty insurance is not commonly used in commercial real estate acquisitions is first, it's typically quite costly, and so the cost is prohibitive. And the second is that the insurer providing the insurance needs a period of time to underwrite the insurance and to do its diligence, and typically that extended period doesn't always match up with the timeline that the seller and the buyer are looking to close the transaction in. You know, generally speaking, commercial real estate acquisitions are on a fast timeline. The buyer typically has a financing that it's lined up that needs to close quickly. The seller obviously is keen on closing quickly, and so given the typical speed of a commercial real estate acquisition, there's usually just not enough time for an insurer to get in there, do its diligence, and get comfortable providing the insurance in time for the closing. And so I think for those two reasons, we haven't seen it as much in commercial real estate acquisitions, but it is a growing market. It is a changing market. So it will be interesting to see how common it becomes over the next 5, 10, 20 years.
Thanks. So you alluded to this earlier, but let's say your client closes on the acquisition and then subsequently discovers an issue. What then?
Well, we've already set the stage to some extent, Kris, in that the contract will likely provide limited recourse on the part of the purchaser to the seller after closing. There may be some percentage of the purchase price available for recovery, but capped at a small percentage of the purchase price, and the time period during which the reps and warranties survive will also be limited. The key for this market will be to essentially understand the economics of the transaction. What is the seller realizing out of the transaction? Is the seller realizing a substantial or at least some return over the outstanding debt amount? In this environment, in a distressed transaction, you could certainly foresee circumstances where the seller is essentially recovering nothing on its investment. The purchase price would be essentially the amount of the debt, or maybe even a percentage of the debt if the seller and the lender and its lender agreed to some discount against the principal amount. The purchaser needs to understand that dynamic, and whether essentially the lender here will be controlling the discussion. For instance, if the purchaser is to understand that the seller is not recovering anything over its debt amount, then the remedies available to the purchaser for post-closing breach of a representation might actually be driven more by a discussion with the lender and what the lender is willing to tolerate than what the seller is prepared to do. The remedies available to a purchaser would be, if you think along a continuum, at the ideal end, a holdback against the purchase price. That is, in today's market, and certainly in a distressed market, not something that one would typically see. So the purchaser is then left with alternatives. Can it escrow a portion of the purchase price so as to be able to draw against that escrow, often held by the title insurer, if there is a valid claim for a breach of representation? If the lender is only recovering its debt or a portion of its debt, it may be unwilling to agree to any post-closing escrow. But that, again, will be a function of the market. There are theoretically other avenues available for a purchaser to pursue. One could envision, let's say, a parent company guarantee by the seller's parent of the post-closing obligations of the seller. One could perhaps envision a circumstance where the seller would post a letter of credit to serve as security for the purchaser's obligations. However, in the environment that we are seeing and will expect to foresee for the foreseeable future, it's, I think, unlikely that a guarantee or a letter of credit would be available or efficacious. Thanks.
Thank you, John. Thank you, Jonathan.
Thank you.
For years, we've been seeing a steady increase in direct real estate investment by well-diversified private capital investors through joint venture structures alongside day-to-day operator sponsors. Many of these investors are now actually in a better position to invest in distressed real estate than they were during the last financial crisis, because now they have the team, the experience, and the sponsor relationships. Those sponsors are likely reaching out now or will soon with opportunities to invest in distressed assets. Real estate partner Lisa Brill and real estate associate Eric Felcher join me next to provide some tips when negotiating the joint venture agreement in this current market.
Will the negotiation of a JV agreement in connection with a distressed asset differ very much from the negotiation relating to a more stable asset?
So Kris, we don't believe that the negotiation of a joint venture agreement in the context of a distressed asset will differ drastically from the negotiation of joint venture agreement in the context of a non-distressed asset. I think the parties will really have to look at the business strategy revolving around the asset itself. Generally speaking, when we're looking at a joint venture agreement, we're really looking at three components broadly. First is capital. How's money coming into the joint venture? How's money leaving? So for example, capital contributions, it's a way that money can come in, financing, whether it be the joint venture or subsidiary, entering into financing with respect to the asset, and money leaving, such as distributions, possibly in the connection with the promote, also built into those distributions, or liquidation. Second component really relates to management, who's running the day-to-day operations, and who and what decisions essentially are subject to the approval of the other partners of the joint venture, aka major decisions. And the third component really ties to exit. What rights do the parties have to leave the joint venture? Your customary exit rights, such as buy sells, for sale ROFOs, or just permitted transfers under the joint venture agreement.
Yeah, thanks, Eric. So as Eric mentioned, when we were considering your question, Kris, we really thought these three main components that you focus on when you negotiate any joint venture are going to remain relevant clearly when you're dealing with a distressed asset. And what's really going to be important is thinking about these three components in the context of your asset and what particular things you need to be thinking about in terms of the capital that's going to be required, timing for when that capital is going to be required, the conditions for contributing that capital, management, meaning are there particular major decisions with respect to that asset that are important given its distressed nature and given the plan for that asset in terms of whether or not it's a repositioning, whether or not it's a complete renovation of that asset, whatever it is. And then also, given the fact that it is a distressed asset, there are a number of unknowns. Should we be thinking any differently about exit opportunities? Should they potentially come sooner rather than later? Because it might be that you aren't able to reposition your asset in the timeline that you had initially envisioned.
Thank you. What should parties be thinking about with respect to those three areas of focus in a JV agreement that you just mentioned?
Yeah, thanks, Kris. So we'll delve into it a little bit more. Let's talk about capital first. So obviously, when you acquire an asset, there's typically an initial capital contribution, but then there are typically additional capital contributions that are required for various purposes. And those purposes might be in connection with development or repositioning. They might be in connection with operating expenses, et cetera. So it's really important, especially if it's a distressed asset, and there might be some unknowns related to its repositioning or how the joint venture plans on dealing with the asset in the future, that the parties going into it should really understand what their capital obligations are and when they're planning on putting in capital. So for example, it might be that if it is in connection with a redevelopment of the asset, that there might be cost overruns in the future, especially now in this COVID environment where we've seen delays, we've seen instances where there have been disruption. So what happens if there are cost overruns due to force majeure, due to any other reason? What happens if there isn't sufficient income from operation of the asset to cover its operating expenses? So we think that, the parties in negotiating a joint venture agreement should really focus on the need for capital, when it's going to come up, who's responsible for contributing it. Is it pro rata contributions? Is it a situation where one party might have disproportionate obligations with respect to contributing capital because it's in a management position? So again, we really think that given the nature of the asset, that the parties should be really focused on the capital, capital contributions. And then related to that, with respect to distributions, obviously we're not necessarily expecting to see a lot of difference in the nature of distributions with respect to distressed assets, as with in the ordinary course of business. However, it might be that a party who has put in additional capital, let's say to cover cost overruns when another party didn't, might be able to get that money out sooner or something like that. So the parties should really be focusing on the dollars in and the dollars out. Eric, do you want to talk about what we should be thinking a little bit with respect to management?
Sure. Thanks, Lisa. With respect to management, I think the parties are probably going to be focusing on major decisions. And I think the major decisions in a distressed context are going to be really tied to the transaction itself. So for example, if the parties are forced to close on a distressed asset rather quickly, they may not have time to pre-negotiate certain items in a joint venture agreement, such as a budget, a business plan, a construction schedule, like Lisa was saying, in the context of a repositioning where work has to be performed on the asset. So if those items aren't pre-negotiated, they'll likely be included as additional major decisions that supplement your customary major decisions in a joint venture agreement. And also in that context, the parties may look to the customary major decisions and scrutinize things such as the variance thresholds or other floors and ceilings that parties typically will negotiate in those major decisions. Also, in a distressed context, people may be thinking about, well, what happens in a deadlock because we're including additional major decisions. So typically a deadlock would result in a trigger to an exit right, provided that you're outside of the lockout period. But in the context of a distressed asset, the parties may potentially negotiate a more robust deadlock mechanism where maybe the executives at the joint venture partners have to discuss, or they have to hold certain in-person meetings. There could even be a cooling period before the parties would otherwise be able to exercise an exit right as a result of a deadlock. So things like that are probably additional thoughts that parties will have when negotiating a joint venture agreement. But again, it's really going to tie to your specific transaction type and how that transaction and your plan with respect to the asset will kind of play out.
Yeah, and I'm going to take what Eric just mentioned and tie it to exit rights, which is sort of the last sort of set of issues that we really think about in a joint venture context, which is as Eric said, what we typically see with respect to a stabilized asset or the development of an asset is that there'd be some sort of lockout period before which the parties would agree that they won't, they won't sell the asset during the lockout period, and there won't be any significant transfers prior to the end of the lockout period. And the idea is that the parties have really already agreed on their business plan, they've agreed on their budget, they've entered into this joint venture agreement, and really they're business partners, they should figure out a way to get this done. One of the things that we've seen in the past with respect to distressed assets is you often have to move quickly. And in moving quickly, you might need to negotiate and close your joint venture agreement before you've agreed on some of these key things like your budget and business plan and construction schedule or redevelopment schedule, as Eric mentioned. And so because of that, you might say, listen, we really hope that within the next 6 months, 9 months, whatever it is, that we're really able to agree on these things. But if we aren't able to agree on them, we should have an exit right or way to sell the asset or exercise some sort of buy, sell, or for sale ROFO or something like that. So we would definitely see the parties consider whether or not they need to have additional exit rights or exit rights that come sooner with respect to the asset than we would maybe in the ordinary course, just given the speed with which some of these transactions might need to be consummated. Or again, given the fact that, market conditions might change and such that you need more flexibility, even if you've agreed to these things up front, it could be that given the current environment, you need a little more flexibility to change your business plan, change your budget, et cetera. And again, what happens if the parties can't agree on that? Arbitration is really not a satisfactory dispute resolution mechanism when it comes to business decisions. So it might be that you look at your exit rights and your exit opportunities as part of being able to resolve those deadlocks and decisions. And then, obviously, if you're dealing with an asset that's going to require a lot of care and attention, you're probably really focused on who your partner is. And so you might want to scrutinize transfer rights a little bit more and make sure that you know where the money is coming from, that you make sure you know who the decision makers are. And again, these are things that we do in joint venture agreements all the time. So it's not really that different. But again, if you are expecting that your partner has significant experience with this type of asset, you might want to make sure that you are really focused on who the key people are and who really is going to be there on a day-to-day basis. And you might want to limit transferability until your asset has been appropriately repositioned.
Great. Thank you, Lisa. Thank you, Eric.
Real estate investors are preparing for what could be a once-in-a-generation opportunity to buy distressed real estate assets at bargain prices with financing at historically low interest rates. The pandemic has also put many commercial real estate loans on shaky ground. Distressed lending proved particularly useful during the last financial crisis as a source of capital. Also, some investors are considering buying distressed non-performing notes for a loan-to-own strategy, a practice that was common during the last downturn. Partner and head of real estate Malcolm Montgomery, real estate counsel Mike Pettingill, and real estate associate Horton McKinney join me next to provide a high-level review of finance-related items to consider as investors pursue distressed real estate.
What strategies should investors be thinking about to obtain favorable financing for the purchase of distressed assets?
So thanks for having us, Kris. The first thing that an investor should think about is whether they're buying assets in bulk or on an asset-by-asset basis. Buying in bulk and getting new financing relating to the assets on a bulk asset purchase basis can have some real benefits. There's a lot of creative debt capital out there. It's sitting on the sidelines right now. It's waiting for opportunities to come in and finance purchases of distressed assets. You can often obtain better financing terms if you're doing a bulk asset financing. And for example, the financing on that on a portfolio basis can be tranched in the background into an AB tranche, set of tranches, such that your pricing can be even more favorable because of that. If you buy assets in bulk, the assets that have a higher cost of turning around or a lower return can be weeded out and resold. And so we saw in the last cycle that the investors who really made a killing in the market would buy a large portfolio, weed out the assets that they didn't want to keep, or resell those, and then work through the assets in the portfolio that were left. And you can do that with creative financing terms as well. But it may be possible for you certainly to finance assets on a asset-by-asset basis as well. And Horton will talk a little bit about some of the considerations that come with that.
Right. So when you're really trying to target a single asset, in these types of situations, you might run into a situation where your reserve requirements are a little bit more robust than they otherwise would be during a more traditional cycle. So, if you're looking at a hotel, there might be FF&E reserves that are a little bit more strict, and that can include, other reserves will include your debt service, your tax, and your insurance. So when these things happen, we see those coming in a little bit more aggressive on the lender side. In addition, oftentimes you'll see a lower loan-to-value ratio, and there could be even more stringent management and manager requirements. So, and as Malcolm touched on the debt capital structure, on the portfolio basis, even on the single asset basis, you can still consider, other debt structures like a preferred equity or even a mezz loan to help you with getting your more favorable financing terms. In addition, one thing to consider, it will be speed. You'll want to try to work with a lender who can work quickly in these situations. So it's important to work with build a relationship with somebody who can target the asset and move through their internal processes quickly.
Great, thank you. What are the strategies to consider when assuming the existing financing on the asset being purchased?
I'll address that. First, know your lender. If the existing lender is CMBS and the loan is in special servicing, you have to think long and hard about trying to assume that loan. Special servicers, currently are completely overwhelmed. There's, a lot of problems getting them to be responsive. And then when you do get their attention, of course, they're under a lot of restrictions under the pooling and servicing agreement that governs how they can act in accordance with the loan. So CMBS loans are more difficult. If you are going to go down the path of trying to assume a CMBS loan, you need to get on top of it right away, because to get the special servicer's attention and have enough lead time to get it in place. Alternatively, if the existing lender is a bank or an insurance company, and there's some value in the property, of course, still, they might be more willing to work with you. Especially if you have a track record, known investor, of course, if you have a pre-existing relationship with the lender, that would be very helpful, because it's a relationship business, especially in this sort of circumstance where an asset is probably to start with. So that's most important. It's know exactly where the borrower is vis-a-vis his lender, completely underwater or not, and know who you're dealing with when you get the process started.
Do you have any remarks about so-called loan-to-own strategies?
Yeah, I can take that one, Kris. So it could be that the best investment strategy is to buy a debt position and try to convert that into ownership of an asset. Those investment strategies can be pretty risky. We could have a whole separate program on the types of issues that come up in loan-to-own and foreclosure and enforcement strategies. But let me just tick off a few of the issues that you have to contend with. One is those situations can be very complex. You need to understand from a diligence perspective exactly what's happened during the entire life cycle of the loan up until the point where you purchased it. You'll want to review the entire correspondence file, and you'll want to understand, for example, what has the existing lender done? Have there been past defaults? Have those defaults been cured? Were any enforcement actions taken? If you're in California, for example, did the lender take any actions that could have violated the one form of action rule in California? Because that could have a disastrous effect on your ability to realize on the collateral. What are the foreclosure requirements in your particular jurisdiction where the asset sits? Is non-judicial foreclosure available, or are you stuck with judicial foreclosure where there could be foreclosure moratorium legislation in place? That's a big factor. We currently see UCC sales taking place, so those doing a UCC sale could be a good strategy. If you are acquiring an interest in an asset through a UCC sale, though, will your intercreditor agreement and will the terms of the underlying mortgage financing allow you sufficient time to implement your post-foreclosure strategy on the asset and right the ship before you're out of time under your senior financing and have to worry about replacing that or injecting additional capital? These are all the kinds of issues that acquirers of debt positions have to think about, especially if it's a loan-to-own type scenario.
Got it. Great. Thank you, Malcolm. Thank you, Mike. Thank you, Horton.
Thanks for having us.
Thanks.
I think we all recognize the importance of due diligence in real estate for any type of asset and at any point of the economic cycle, even during the best of times. But particular skill and experience is critical when in the market to invest in distressed property, when timelines are truncated and hidden diligence issues are more likely. Real estate counsel Jocelyn Redman and real estate associate Helen Quigley join me next to deliver a few key insights on legal due diligence in this context.
Could you first describe the first step in the diligence process? How does the due diligence starting point for a distressed asset differ from a deal involving a more stable asset or seller?
Helen, why don't you start?
Sure. So the diligence process at the onset for a distressed asset is very similar for the diligence in a regular closing, with the understanding that the deal timeline might be very truncated and you might not actually get the full scope of diligence. But items you're going to at least try to request are property level documents, so leases, service contracts, title and survey documents, any lead time items, much like a regular closing, you're going to try to get order as quickly as possible ahead of time. So if you are looking to get an environmental or an updated title or survey, try to order those as soon as possible. So you know, in order to properly assess in the timeline given. Other items that you're going to want to look out for in the distressed world, you sort of are dealing with a property that has already been, performing or unperforming, and so you're going to want to take a look at the borrower, the guarantor, make sure that the guarantor is a credit-worthy entity. Is the borrower a single-purpose entity? If there is a loan on the property, take a look at the loan documents and try to confirm the current status of the loan, whether or not it's in default. And then if the property is leased, any tenant estoppels, try to get updated ones.
Great. When reviewing the diligence files, what items are of particular importance?
Yeah, so I was going to take that question, Kris. Obviously it's going to depend on what we see coming out of the diligence matters, but certain items to specifically consider or look out for. One is any co-tenancy clauses in leases if the property has a retail component or is fully retail. A lot of times a tenant may say, listen, we only want to be in this space if there's a certain anchor tenant or another tenant in there, and so there may be provisions that specifically allow a tenant to pay less rent, to pay no rent, or to terminate. So you want to take into account that because obviously it's going to affect the sort of cash flow from the assets. As Helen said, one of the more important things will be, certain reports and searches and title searches. So looking at title, looking at updated title, seeing if there's any intervening liens that have been filed against the property, if it has been underperforming, if the borrower sponsor hasn't been putting in any money, there may be mechanics liens, there may be other judgments, and so obviously taking into account any of those items and how that might affect purchase price or timing for closing. Deferred maintenance, we also would look out for. Again, this may come up in a tenant estoppel, it may come up in a third-party report, but just understanding if there's any major deferred maintenance out there that again is going to affect underlying value. And then if the client is looking at an acquisition of a distressed a loan, it's going to be important to see any and all correspondence that exists between the borrower and the lender at the time to see, are there going to be any defenses to repayment that the borrower may have, any potential lender liability claims, where there are rejections of requests or non-responsiveness or things like that. So we'd want to carefully review the file to see those issues.
Great. Are there any other special considerations for diligence on a distressed asset?
Yeah, so on a distressed asset, the closing becomes less of a let's get all issues resolved prior to closing and more of an issue spotting. Okay, what can we live with? What can't we live with? And does the asset actually support the purchase price? And so especially in the distressed world, you might be dealing with uncooperative sellers, especially if they're viewing this as a fire sale. They might not be willing to go out and give you the full scope of diligence. Maybe they don't want to bother their tenants for updated estoppels. Maybe there's not enough time to run the full scope of third-party reports that you typically be used to. If this is a loan, maybe the property owner doesn't know that the property is being sold and you might not have access to actually go and inspect the property. And all of these might be okay, but this is really where counsel comes in handy, who can come in and we can just advise you on what risks are acceptable, what items you should actually push for, whether or not any adjustments need to be made to the purchase price depending on what actually gets unearthed during the diligence process.
Great. Thank you. Thank you, Jocelyn. Thank you, Helen.
Thank you.
Real estate transactions usually do not get very far off the ground without first having completely understood the potential tax exposure and the desired tax structure. The tax consequences of a commercial real estate investment are typically evaluated during the very beginning stages of the transaction. Tax partner Mike Shulman and tax counsel Derek Kershaw join me next to provide a high-level review of tax-related items to consider when pursuing distressed real estate.
How do the tax benefits of investing in distressed commercial real estate mitigate some of the business risks?
Thanks, Kris. I'll address that. The tax benefits that you get from investing in distressed real estate first include interest deductions. The real estate is usually heavily encumbered by debt, which may be high yield debt, and there are significant interest payments required to be made or interest that is accruing and cannot be paid. Fortunately, under the US tax rules with respect to interest, a real property trade or business can elect out of the restrictions on deducting the interest expense by making an election to be an electing real property trade or business. And in the case of commercial real estate, non-residential real estate, the only penalty for making that election is an additional year of spreading out your depreciation. You spread it out over 40 years instead of 39 years. But the benefit is quite significant because the interest, while potentially subject to other limitations, is not subject to the 30% of earnings limitation under the new tax law. So that can be quite significant, that benefit. Losses, including interest deductions, are subject to several limitations on when they can be used, particularly in the case of individuals. So if you are investing in commercial real estate through a partnership structure, the losses that flow up from the partnership are subject to limitation under the past activity loss rules, starting in 2021, the excess business loss rules, the so-called at-risk rules, and the limitation of the partner's basis in the partnership. But with respect to the at-risk rules, the individuals that are owning through a partnership can count non-recourse debt as an amount at risk, which can greatly increase the amount of losses that they can actually currently claim against their other types of income. And that is because the debt is often treated as qualified non-recourse financing, which generally is secured non-recourse debt where the lender is an unrelated bank or other person engaged in the business of lending money. It's still the case that individuals have to watch out for the passive activity loss rules unless they are materially participating in the business of real estate holding or real estate development. Bonus depreciation can be an additional benefit upon acquiring distressed commercial real estate. A lot of the value of some types of buildings like hotels can be in the form of what's called qualified improvement property, which is certain improvements to the interior of a building that doesn't count as part of the structure for tax purposes. And the entire cost of that part of the building or project can be written off as bonus depreciation right away, which is potentially going to be able to is going to allow you to shelter income that you have from other investments. And lastly, distressed real estate in many cases, particularly because of the interest deductions, doesn't really produce positive net taxable income until there's a sale. And if the property is repositioned and held for a total of at least 3 years, the gain generally is capital gain, which for individuals is taxed at a lower rate. Some of the gain would be taxed at a 25% rate, but generally speaking, the gain over and above the cost of the property will be eligible for long-term capital gain treatment after 3 years, including any amounts that are paid as carried interest or promote.
Thank you. Thinking about the tax consequences of a workout, what are some of the traps for the unwary?
So I think there are 3 points we would really stress here when considering doing a workout. So the first point is that, as Derek mentioned, the status of debt as qualified non-recourse financing is very important from an at-risk perspective. It basically gives the partners room to deduct losses in excess of the amount of capital that they've invested. But one of the requirements to be qualified non-recourse financing is that no partner bear the economic risk of loss with respect to the debt. So in the context of a workout, if one of the changes that's made as part of the workout is one or more of the partners need to guarantee that debt, that might give those partners who guarantee the debt additional amount at risk. But for other partners, it will deprive them of their share of the at-risk amount. And what that can do is it can result in a negative at-risk amount, which effectively requires recapture. Or even if there's no recapture, it can reduce that at-risk amount, which can reduce the amount of deductions allowed going forward. The second concern here is that a partner's basis in the partnership is increased by its share of liabilities of the partnership. And that increased basis gives the partners additional room to deduct losses and deductions of the partnership to the extent it's allowed to under the at-risk rules. And so, again, if one of the partners guarantees the debt as part of the workout, that can cause a shifting of the allocation of the guaranteed liabilities away from the other partners and to the guarantor. That reduces the other partners' bases in their partnership interest and either could cause recapture of income or recapture of prior deductions, or it could limit the ability to deduct losses of the partnership on a going forward basis. The third and last concern is the possibility that the workout will result in cancellation of indebtedness income, or what we call COD income. And COD income results when the issue price of a new debt is greater than the adjusted issue price of an old debt. So for example, in the context of non-traded debt, this can occur when the workout results in a reduction of the principal amount of the debt. And generally, COD income flows through to the partners of the partnership unless an exception applies. One potentially helpful exception is the exception for insolvent taxpayers, but that exception is applied at the partner level, meaning that even if the partnership that is the debtor is insolvent, it can't itself avail itself of the insolvency exception. Instead, the COD income flows through to the partner, and only if the partner itself is insolvent can it use the insolvency exception. There is a separate exception, which is for qualified real property business indebtedness. And for that type of indebtedness, there's a potential exception that can apply to the extent that the amount of the debt before the workout exceeds the value of the property, meaning it only applies to the extent that the property is underwater at the time of the restructuring, but that can be helpful in effectively avoiding COD income. There is a cost, however, which is that the partnership would be required to reduce its basis in its assets by the amount of COD income excluded. So while there would be no current recognition of income, it would reduce the basis used for depreciation and gain recognition in the future.
Great. Thank you, Mike. Thank you, Derek.
Thank you, Kris.
Happy.
As investors start to think about buying distressed real estate, it's important not to lose sight of the bankruptcy risks that may change the outlook of a deal dramatically from a commercial and practical perspective. Navigating those hidden issues will be vital when searching for opportunities to acquire real estate at a perceived discount. Bankruptcy partner Ned Schodek joins me next to provide a high-level review of bankruptcy-related items to consider when pursuing real estate from a distressed seller.
What are the central benefits and risks associated with purchasing real estate and other assets from a distressed company?
So I think, look, from the company perspective, distressed companies often look to asset sales as a way to generate new sources of liquidity and avoid bankruptcy. And from a buyer's perspective, distressed acquisitions, be it real estate or other assets outside of bankruptcy, may provide greater opportunities to obtain assets at discounted prices. So I'd say those are the primary benefits to both parties. But those opportunities for buyers definitely come with risks outside the Chapter 11 context, including increased risk of subsequent challenge of the asset sale as a fraudulent conveyance. In bankruptcy, you'd have the ability to buy assets free and clear of existing claims and liens, and you wouldn't have that in a non-Chapter 11 acquisition. Then there's just increased risk of successor liability attaching to the purchaser, because you can cut that off a bit in Chapter 11. And you have, outside of the free and clear right, you'd have to get secured creditors to voluntarily release any mortgages they have and liens on the assets. And often that requires 100% of lenders and bondholders. And sometimes obtaining that consent can be difficult, time-consuming, and expensive.
You mentioned fraudulent conveyance risk. Can you explain what a fraudulent conveyance is?
Sure. So a debtor in Chapter 11 has the right to avoid certain fraudulent conveyances within certain look-back periods. And a fraudulent conveyance is generally a transfer of its property. So it could include an asset sale to a third party prior to the commencement of the Chapter 11 case that was either made with actual intent to hinder, delay, or defraud the debtor's creditors, which is pretty unusual and really probably not applicable here. But there's also constructive fraudulent conveyance, which is a transfer made while the debtor was insolvent and for which the debtor didn't receive reasonably equivalent value. So if you're buying from a distressed company and it's later determined that the company was insolvent and you didn't pay enough for the assets, you could have an issue there.
Thanks. So recognize it's a big topic, but what are the most important things to know about bankruptcy in a nutshell?
Yeah, sure. I mean, look, it's definitely a big topic, but I'd say for people that haven't been involved in bankruptcies before, probably the key things to know are, once there's a filing, there's an automatic stay, so you can't just go foreclosing on a debtor's assets. It stops all litigation and prevents new suits from being filed. Another kind of surprising thing about Chapter 11 to a lot of people is that provisions in contracts that purport to terminate them based on a bankruptcy filing are unenforceable. So you see that in every contract, but it's in most cases it's not enforceable in a Chapter 11 case. And I'd say another important thing to know is that in Chapter 11, a debtor has the ability to assume or reject contracts. So if you're entering into a purchase agreement with a company that's distressed and they later file for bankruptcy and you haven't closed, you can't really, force them to close. And finally, probably the most important thing to know about Chapter 11 is, its ultimate goal, which is a plan of reorganization that and that's the goal of the case, and it divides creditors into classes, and you have to get approval by holders of at least 1/2 a number of claims that actually voted and 2/3 in dollar amount. And then even if you don't get approval of every single class, you can still confirm it via a cram down if certain requirements are met.
You often hear the term SARE case come up in the real estate context. What does that refer to?
So that refers to single asset real estate debtors, which are fairly rare because the definition of a SARE debtor is pretty limited, but they have to have basically a single property or project and get all their revenue from the property in question, and not really conduct substantial business other than operating the real property. And the real difference there between that and a normal Chapter 11 case is that a SARE case follows an accelerated timeline. So they have to either get a SARE debtor either has to get a plan on file within 90 days or start paying interest on the secured debt within 90 days of the filing.
Got it. What's different about sales of real estate and other assets in bankruptcy? You often hear about 363 sales. What are those?
So Section 363 is a provision of the Bankruptcy Code. So with the automatic stay I mentioned, there's also the requirement to go before the bankruptcy court to seek approval of transactions outside the ordinary course of business, which would certainly include asset sales. So if you're seeking to acquire assets from a debtor in bankruptcy, it has to go seek a bankruptcy court approval of that, and generally establish a sound business justification for the sale. So sound business reason, it has to give notice to parties in interest. The price has to be adequate. And there's a fiduciary duty to seek the highest and best offer, which generally means that you have to prove that by a market test of the purchase price. So an open auction is generally required. So that's one of the things if you're buying from a debtor in bankruptcy, you have to realize is that there's going to be an auction process. The good thing about bankruptcy is that prospective buyers are relatively free to select the assets they wish to purchase and liabilities, if any, they wish to assume, including selecting contracts that they want assigned to them. And on that, as a general rule, contracts can be signed notwithstanding anti-assignment provisions and contracts in bankruptcy. And, in connection with the auction, in order to induce buyers into signing an APA that's binding on them during the auction and approval process. Courts typically will approve bid procedures to protect the stocking horse bidder, so you can get a breakup fee. Usually that's between 1 to 3% of the purchase price, expense reimbursements, overbid protections, although those have to be all have to be reasonable.
So you previously mentioned being able to purchase assets free and clear in a bankruptcy. Could you elaborate on that?
Yeah, sure. So that's one of the greatest benefits of a Section 363 sale, is that you're able to purchase the assets free and clear of all liens, claims, and interest. And so the liens of secured creditors will actually attach to the purchase price, not the assets being sold. And if the sale process is well run, creditors have limited ability to oppose the sale because their rights are redirected to the sale proceeds. And also, as a general rule, the free and clear nature of 363 sales eliminates successor liability with respect to the assets that are purchased. Obviously with certain exceptions, like you have limited ability to cut off certain successor liability claims, and the sale is also not going to protect the purchaser against claims that arose from post-sale operations of the business, of course.
Great. Thank you, Ned.
No problem. My pleasure.
Environmental risk is always a concern, but should especially not be overlooked when parties are moving quickly to acquire a distressed asset. The exposure to the cost of remediation could very easily outweigh the opportunity to acquire an asset at a perceived discount. Jake Pratt and Mehran Massih co-lead Shearman's global environmental practice, and they join me next to provide a high-level review of environmental-related items to consider.
What are some of the environmental specific concerns when a client is looking to acquire distressed assets?
Sure. Thanks for the question, Kris. I think to start off, the concerns, the environmental concerns are quite similar to the non-environmental concerns. If we're looking at a distressed asset, we anticipate that there's not going to be any meaningful indemnity from the seller, and that heightens the need to conduct environmental due diligence to understand the issues. And it also suggests the need to look at alternative forms of protection from environmental liabilities, in addition to traditional indemnity, which again, we might not be receiving, or we might be receiving from a seller that we don't think is adequately funded or will be able to stand behind the indemnity. And a second point regarding the environmental due diligence is the EHS budget, when you're looking at a distressed entity, it's not the first item that gets cut, but it's also not the last. And you really want to look at what a company is doing with an asset from an EHS perspective when it's in distress. Because if it has cut the EHS budget, you may have people trying to implement cleanups or implement asbestos abatement projects, et cetera, that don't have a lot of experience doing it. And the ramifications for not doing it adequately or not doing it in accordance with regulation can be quite significant. So, for those reasons, I think there's an added and heightened need to conduct a robust due diligence exercise. When we're looking at a distressed asset, there are certain protections that are environmental specific that I think we can consider that might make acquiring a distressed asset more palatable than it might otherwise be. The first is the defenses under CERCLA or the Superfund law. Typically, when you acquire an asset as the new owner, you're strictly responsible for any soil or groundwater contamination on the property. However, under federal law and many state analogs, there are protections against that liability, which is strict. But it requires conducting an ASTM 152713 phase 1 assessment. So as part of the due diligence and to establish these defenses, we would recommend a heightened importance of conducting adequate phase 1s to establish the defenses. And by the way, those CERCLA defenses are relevant both in the case of unknown contamination that is not discovered pursuant to the due diligence process, but may be discovered after closing. And for known contamination, you can actually get some protection from soil and groundwater contamination that you know affect an asset, despite the fact you become an owner. Secondly, with respect to unknown issues, again, typically you might receive an indemnity from a seller for unknown issues. But if in the distressed asset context, maybe you're not as comfortable with that protection, so you may consider environmental insurance. Environmental insurance will not cover known issues, but it will cover unknown issues. Thirdly, with respect to known issues, you may consider a covenant not to sue. In other words, if you have a distressed asset and you know that it has soil and groundwater contamination, you may want to consider whether a governmental entity would be willing to promise not to sue you, especially in the context if other parties have been identified as responsible for the contamination.
And I think,
lastly,
sorry, on that
please,
point on covenants not to sue, Kris, I think there is one particular facet that we can discuss, which is brownfield cleanup programs. Most states in the US have some version of a brownfield cleanup program, which, is often the context in which commercial assets with a legacy of environmental issues are remediated. And the key to note in a distressed asset context about them is that they are quite administratively specific, and there are several hoops to jump through in terms of the application for a particular program and whether the eligibility requirements are going to be met in order to get the ultimate prize under the program, which is liability protection. I mean, that's basically the carrot in a brownfield cleanup program. And you'll often find that in the commercial real estate context, that's where the environmental work is being done. But for purchasers in a distressed context, one key thing to note is, what is the scope of that liability protection? Who is giving it? Is it a regulator? Are they only promising not to go after the applicant, assuming they're eligible, in connection with the identified contamination? Or are they also providing some covenant not to sue that runs with the land and that will apply to future owners, for example? Obviously, the benefit of that would be greater. Does the liability protection extend to prevent private party claimants, as well as the regulator providing it? And then finally on that, I would say, what are the reopeners under the liability protection? There almost always are. So that if new information is discovered, or if there's an exacerbation of an issue that had been identified in a particular way for the regulator, they might be able to come back. So all of these exceptions and carve-outs are something to note in a distress context.
And in that context, the covenants to sue we typically see, they're definitely not a covenant to defend. And so in terms of third-party claimants bringing claims against a purchaser of an asset, typically the covenant not to sue by a regulator would simply include a covenant that it would indicate to the third-party claimant that from the regulator's perspective, that the purchaser should be off the hook and has satisfied its obligations under the relevant statute. But it's not a covenant that the regulator will actually go to court and defend the purchaser. So just to emphasize Mehran's point, that understanding the limitations of a covenant not to sue is an important consideration as well. And I would add, I think that's relevant with respect to the CERCLA defenses, which require ongoing management of any contamination that's either discovered post-closing or that's known at closing. And in terms of environmental insurance, there's always carve-outs and exceptions to coverage. So not, as Mehran indicates, not to suggest that any of these are 100% foolproof. So understanding, the protections you're getting and what the risks remain after acquiring some of these protections is critical. And I guess, I'm looking lastly in the bankruptcy context, in the context of a 363 acquisition out of bankruptcy, typically you enter into an asset purchase agreement, for instance, but that has to be blessed by the bankruptcy court. And before you can consummate that transaction, the bankruptcy court has to bless it in the form of an order. And the orders we typically see with distressed properties do include at least often a fairly robust language on the part of the bankruptcy court saying that the purchaser is acquiring the property free and clear of any claims or liabilities that attach to that property. So, when you're acquiring an asset out of bankruptcy, you do want to scrutinize closely and see if you have any leverage to see that it includes language that purports to exonerate or protect the acquirer from any liabilities associated with the asset.
Great. Thank you, Jake. Thank you, Mehran.
Certainly.
Pleasure.
Thank you for taking the time to watch this webinar. We wish everyone watching well during these difficult times. We hope you and your families are all staying safe and healthy. If you have any questions or would like to discuss any aspect of the presentation, please do not hesitate to reach out to me or any of the presenters. We look forward to hearing from you.